On March 15, 2023, at approximately 10 a.m. Eastern Standard Time, a major financial services firm based in New York City, FinTech Dynamics, experienced a critical error within its proprietary algorithm used for automated trading across various stock exchanges. This algorithm, widely utilized by numerous institutional investors, provided real-time pricing and trading suggestions based on complex market data inputs. Developed 5 years prior, the algorithm relied on a multi-tiered infrastructure, integrating inputs from various data sources and executing trades at high speeds without human intervention. The initial failure stemmed from a minor coding oversight introduced during the last update of the algorithm. The technical team had implemented a new data feed integration, created by a third-party vendor, which had not been adequately vetted for compatibility with existing processes. The oversight did not immediately manifest as a system crash, but instead led to subtle miscalculations in asset valuations. Specifically, the algorithm miscalculated a key input, market liquidity levels, due to an incorrect data format originating from the external feed. This data misconfiguration was compounded by insufficient internal logging practices that failed to capture discrepancies in data input effectively. As trades executed based on the flawed algorithm, the first measurable impact became apparent. Over the next few hours, analysts noted that numerous stocks were being traded at values 10 to 15% lower than their actual market positions based on traditional valuation methods. By midday, the cumulative financial implications were stark. Approximately $200 million in equity trades had executed based on these incorrect valuations, leading to significant losses for investment firms across multiple markets. The rapid-fire execution of decisions based on faulty data created a cascade of pricing discrepancies that rendered some asset valuations untenable. Internally, confusion began to set in at FinTech Dynamics. The compliance team initiated an email thread to discuss the irregularities observed, with subject lines indicating urgent concerns over unexpected trading patterns. Employees flooded the incident channel with reports that trading volumes were higher than historic averages, but the accompanying price movements did not align with what was expected under normal market conditions. A series of internal meetings were held over the next several hours, but the conversations were riddled with a lack of clarity regarding the extent of the issue. Some in the trading department suggested that this might be related to external factors, such as geopolitical events, while others pointed fingers at the recent software update. Externally, the first signs of distress appeared as minor media outlets began to report unusual trading activity across various exchanges. Users began flooding social media channels and online trading forums with inquiries about discrepancies in their portfolios. Monitoring systems started sending alerts regarding unusual trading volumes on the integrated trading platform, indicating abnormal market behavior. Initial reactions from the market were cautious, with some investors opting to pull back from trades, fearing an overarching market anomaly. As days passed, the situation continued to deteriorate. Responses from FinTech Dynamics highlighted the oversight, yet the swift escalation of algorithmic errors only compounded the challenges. An unscheduled audit of the system was initiated, led by the IT department. Meanwhile, attempts to patch the algorithm with temporary fixes led to even further complications. Internal communications reflected a growing sense of urgency, as managers pushed for solutions while still grappling to understand the root cause of the abnormal trading behavior. The broader financial community began to sense a shift in market conditions, as investment firms questioned the reliability of their automated systems. In the ensuing days, dissatisfaction among investors grew. Stakes became increasingly high as further reports emerged from financial analysts, substantiating claims of systemic issues originating from automated trading platforms. With the algorithm failing to respond to market corrections, cross-examination of affected trades revealed that well over $500 million in tangled, mispriced assets were now caught in a widening web of financial instability. Confidence eroded, impacting liquidity and leading to increasing volatility in financial markets. The monitoring alerts that had previously signaled the early phases of irregular trading soon transitioned into warnings of potential liquidity crises. Media coverage of the situation intensified, transitioning from minor mentions to main headlines as concerns about market integrity mobilized attention from regulators. Amidst this escalating chaos, the institution braced for repercussions both from within its ranks and externally from the financial community. Real consequences materialized as clients began withdrawing funds, fearing substantial losses. Communication shifted within the organization from initial responses to crisis management. The IT department facilitated discussions with the vendor behind the faulty data feed, pushing for immediate intervention. Investigations began into whether there were additional vulnerabilities in the system. As external pressure mounted, major stock exchanges convened emergency meetings. Their goal was to assess the broader implications of the ongoing situation, which now bore the potential to ripple throughout the global financial system. Continued reliance on the compromised algorithm revealed a critical vulnerability in automated trading that could not be ignored. Just as fintech Dynamics ramped up its internal investigations, an unexpected dynamic emerged from the technology arm of the firm. Developers discovered that other algorithms deployed across various trading systems harbored similar untested integrations. This revelation prompted an urgent reevaluation of not just the trading algorithm, but also the integrity of a broader range of trading functionalities. The scope of the potential fallout began to extend beyond initial trading discrepancies, heightening concerns regarding systemic ramifications as automated trading solutions became central to market operations. As weeks unfolded, companies across the financial industry began to stow their automated trading strategies, applying halting measures to mitigate an even greater catastrophe. The looming threat of market collapse hovered in the background as regulatory bodies signaled intentions to investigate the stability of automated trading systems on a broader scale. The financial landscape was at a critical juncture, and as unclear as the situation seemed, it remained crucial for institutions to act with transparency moving forward. With the past mistakes unfolding into a serious crisis, the repercussions of the overlooked algorithm error were only beginning to surface. As regulatory investigations moved forward, the findings disclosed a disturbing lack of oversight and protocol adherence across multiple trading platforms. Analysts reported that the algorithm error had become a systemic failure, affecting not only the initial trades but rippling across interdependent financial instruments. With over $1 billion in mispriced assets now at stake, legal scrutiny escalated as affected parties prepared potential lawsuits against fintech Dynamics. In efforts to stabilize the situation, the firm announced a temporary suspension of its algorithmic trading functionality, resulting in cascading delays and losses throughout the market. Trading volumes plunged sharply, and multiple institutions faced immediate liquidity issues as a direct consequence. Prominent hedge funds disclosed substantial losses, accelerating declines in stock prices for related financial entities. the ongoing turmoil led to a double-digit percentage drop in the major stock indices, confirming fears of a market-wide crisis. In response to the compounding failures, federal regulators initiated a formal investigation into fintech dynamics and other involved parties, including vendors and affiliates. Legal notices began circulating, warning companies to preserve critical evidence related to the malfunctioning algorithm and prompting internal audits across multiple firms reliant on similar automated systems. As the situation reached a breaking point, the spotlight turned toward accountability. Senior executives at FinTech Dynamics faced mounting pressure to resign, with internal discussions revealing that there had been significant prior alarms raised about the algorithm's architecture and insufficient quality assurance measures. As key executives stepped down in rapid succession, the company's stock valuation continued to plummet, further eroding stakeholder confidence. The truth surrounding the algorithm error began to emerge as investigative journalists secured internal communication logs that demonstrated a clear pattern of disregarded warnings and rushed decisions. Data traces on the blockchain revealed false trading histories that had propagated the faults downstream, painting a detailed picture of how the crisis materialized. Media scrutiny intensified, with reports detailing the extent of financial damage and further emphasizing the environmental vulnerabilities of automated trading systems. Within months, FinTech Dynamics declared insolvency, filing for bankruptcy protection in a move to avert litigation and secure an orderly restructuring process. As the company began dismantling its assets, law enforcement agencies initiated criminal probes into several senior personnel, focusing on potential securities violations and fraud related to the manipulation of trading algorithms. The aftermath of the incident presented lasting repercussions throughout the global financial sector. Major financial institutions implemented stringent risk management reformulations, enhancing oversight surrounding algorithmic trading practices. There was a significant push for regulatory measures to reinforce transparency and accountability in automated trading processes. In conclusion, the ramifications of the overlooked algorithm error echoed through the financial landscape much longer than initial projections. What began as a minor algorithmic glitch manifested into an unprecedented market crisis that prompted widespread institutional upheaval and regulatory reevaluation. As of December 2023, FinTech Dynamics remains defunct, having dissolved with significant losses impacting numerous parties across the industry. Ongoing lawsuits and investigations continue to unfold, revealing further details surrounding the culprits behind the failure, confirming a permanently altered state within the automated trading landscape.